Okay, hello everyone. This is a slide that I came up with after being inspired by AK71 and TTI. Alright, REITs that I like sorted by percentage properties in Singapore. Right, so I'll explain why I sort them by percentage properties in Singapore in a while. Okay, please note that I'm not a financial advisor. This is not financial advice. I do not make buy or sell calls. I may make mistakes. Do not take my information as guaranteed correct. Okay, opinions that I have are for educational purposes alone, and I may be invested and biased on the stocks I discuss. Okay, please consult your financial advisor regarding any risks involved in investing. Okay, anyway, back to the idea behind this PowerPoint presentation, right? So I'm inspired by both AK71 and TTI, right? If you don't know who AK71 is, I think he retired by I think somewhere around 40 years old or something like that. Alright, and he has currently a portfolio that gives him $200,000 a year, which is like probably twice the average person's yearly income if they work. And this is off the fact that he doesn't work and he plays computer games all day. Right, so this is a very good video. I'll put the link in the description below so you can click on this. Alright, so the essence of what he discussed is similar to TTI. My Mandarin isn't very good, so sorry if I'm wrong. I think this is 葵花宝典, which is some kind of secret Chinese manual for martial arts in some legend. Okay, so it's just a very high level kind of book to teach you how to invest in REITs, and he writes a lot of things. Again, I'll put the link in the description below. Alright, and to summarize what he's saying is just very simple. He says, to me, it's very clear that when you invest in REITs, you are simply buying future cash flows. That's all, full stop. Please read that line another 5 times to drum that in, right? That's the essence of what he says. But again, I'll link the description below so you can have a look at it. And that's the essence of what AK talked about as well in his 5th person interview, right? He talks about the fact that he actually doesn't know how much his portfolio is worth or how much he made through trading his portfolio or in terms of capital gains, because all he checks is whether the company can pay him a dividend, because he needs the cash flow to survive. He's currently retired. So these are the ideas behind, I believe, REIT investing that we need to pay attention to. That whether or not the REIT can give us future cash flows, are they stable, right? And so on and so forth, right? So back to why I want to sort it by SG, right? So I think one of the issues with cash flows from REITs that have overseas exposure is FX. Right, so once you have 100% of your REITs in Singapore, you don't need to worry about FX. So it's one less thing to worry about. In investing, this from Joseph Carlson, but I think it's quite pointed in the sense that he talks a lot about the fact that he doesn't like unpredictability, right? So FX is a source of unpredictability, which is why overseas REITs in general tend to trade with a higher premium, higher dividend outlay than local REITs are, because for overseas REITs, there's a risk that SGD, which historically has been very strong, right, can strengthen against the foreign exchange currency that the REIT is taking the rent in, and that will affect DPU, right? So the DPU will drop, right, and that's what we don't like. So that's why foreign REITs tend to trade at a higher DPU to compensate for the risk, right? So anyway, I found that Frasers Centrepoint Trust is one REIT that has 100% of its rents collected in Singapore, right? So they have 10 bonds here. Alright, Centrepoint, I think they recently divested, which many people saw as a good thing, right? Because I think they use some of the money to pay down the rent, pay down their debts, right? Which in this kind of high interest rate environment, which assuming that the 5%, or I think Singapore the interest rate is something like 3.5%, stays longer for an extended period of time, then it's good for the REIT. You won't have to refinance at a higher rate because it's paying down some of its debt. So anyway, so Frasers Centrepoint Trust is a very popular mall. In fact, I think TTI seems to like the mall a lot. Please don't quote me. This is what I think. Alright, so I'm not speaking for TTI or anything like that. Right, but I think one of the great things about this mall is the retail space in the heartlands is always very resilient. Right, even in COVID, people have to go to heartland malls. Heartland malls means malls in the suburban areas which there's high density of population, right, rather than CBD malls, which are in the city and people only go there when they work, right? So that's the upside of Frasers Centrepoint Trust, right? So 100% in Singapore, that's great. CapitaLand Integrated Commercial Trust, right? 2.7% in Singapore. You can see the German and Australia is not very important, right? It's mostly suburban retail, CBD office, and downtown retail, right? So this was what I was contrasting with just now, right? Just now we talk about Frasers Centrepoint, which is pure suburban retail, right? So they are very resilient, right? Downtown retail, the issue is COVID, right? During the COVID lockdown, I think they suffered, all right? Because people don't go down to the office anymore, all right? And if there is a trend towards work from home, which in Singapore is not very prevalent, but so luckily for CICT, right, it's not so prevalent. So in fact, I think they are still doing okay. If I remember, their last results was a positive rental reversion, right, for both this one and this one. All right, so what I like about CICT is strong sponsor, right? So I forgot to say something about Frasers Centrepoint Trust. In my opinion, the parent company is quite heavily indebted. So that's one of the worries I have with FCT. Right? Otherwise, it seems to be a very well managed mall. Right? Anyway, back to CICT. Right? So, but I do believe that for Singapore, if you are betting on its future, right, this kind of downtown retail and CBD office are one of a kind. Right? You can't get them anywhere else. There's only one CBD or Central Business District in Singapore, and so having that space alone is a very big advantage for CICT. That's my opinion. Right? The cons is that it has not done very well since inception, right? So despite the fact that it has such good property, somehow if you look at the returns over the years, it isn't good. All right, the share price has not appreciated as much as other better managed REITs. Okay, so it has the advantage of good assets, but questionable execution, historically anyway. But you could also think of it as mean reversion, that maybe it should catch up soon, right? Because these things are still recovering from COVID, I suppose, and there may be further upside. All right, so it depends on how you want to look at CICT. Right, so Lendlease, I think I talked about this very recently, right? SG focus, right, is 88% in Singapore, right? I think they have strong mall managers, because I'm always quite impressed with the way they manage the malls. Like Parkway is a very old mall, but the footfall is very high, and other places like PLQ seem to be able to draw very strong tenants like Uniqlo and some other brands like I can't remember what the hot plate food store is, but yeah, they always have these some brands that stick with Lendlease malls, right? So I think that's their strength lah. Yeah. Cons, the worry is they are acquiring buildings too fast, right? So the most recent two were GEM and Parkway Parade, right? So if they carry on acquiring at this rate, their debt may be an issue, and also rights issue may be an issue. So if you have this mall, maybe you have this REIT, you may want to stand by cash for rights issue. Right, so anyway, AIMS APAC, this is a AK71's long-standing REIT. The owner is strong. I cannot remember what his name is, but apparently when he took over this REIT when it was about to collapse or something, I suspect near the global financial crisis, alright, the REIT has done very well since, alright. It's always been fair to shareholders and made good decisions in terms of buying and selling the buildings that it has, right? So the cons is a bit of a small REIT, debt is a bit high if I remember correctly, and Australian exposure. I'm not a big fan of being exposed to Australia at this point because of China, right? I think Australia economy is somehow tied to China, and when China slows down, Australia tends to suffer as a result as well. So also this is an FX risk, okay? So CapitaLand, Ascendas, REIT, alright, is next on the list. Hopefully you can see that everything is sorted by percentage in SG lah, right? So AIMS is next on the list, number 4, because it's 73.6% in SG, right? So CapitaLand, Ascendas, REIT, very big, right? the underlying idea behind this REIT is just very big, right? So it has a lot of headroom for debt, right? And you can acquire properties easily because it's very big. So acquiring any property will probably not be a big issue for it. Quite well diversified, right? Not going to say too much about this. It's over NAV at this point, but maybe that's what you get with big REITs lah. Alright, they're so big that they're so stable that you have to pay a premium for them. Alright, Mapletree Pan Asia Commercial Trust. Alright, this one is a big question mark in terms of like it's 54% in Singapore, right? They have a very good mall in Vivo City, right? This one attracts both local and foreign footfall. So this is really the gem in Mapletree Pan Asia Commercial Trust. The problem is with the Hong Kong side Festival Walk, right? I'm not going to bother with all this because I think they are smaller, right? Maybe MBC is a bit more significant, but it's a tale of two malls lah. Basically, VivoCity is very strong, right? And Festival Walk is just not doing well. So this thing is dragging the performance, right? And then there's this worry that we don't know how Hong Kong is going to play out in the long run. It could be that Hong Kong recovers, clearly, but it's very hard to say, right? So again, this is starting to become unpredictable, and you can see the unpredictability comes from overseas, right? Because Singapore generally is very stable. If you have a good asset like VivoCity, I think you are just in a very good position, right? This attracts the foreign as well as the local footfall, and it's a very well situated mall in Singapore, right? Mapletree Industrial Trust, right? This one is actually just 50% data centers, right? The US side is just data centers, right? And then the Singapore side is all these things lah. Okay, so slightly below 50% in Singapore, but traditionally very well managed REIT. Just that in recent years, not recent years, just the last 1 or 2 quarters, it's been affected by interest rates, and so DPU has been dropping, right? So very strong historical record, but the last 1 or 2 quarters, the DPU has been dropping because of interest rates, which you could say is expected. Data centers is a wild card. I don't know whether AI will help boost this side, right? Boost the demand for data centers. So if everybody needs to run AI, they need some place to run they need the data centers to run AI for many people, right? Then this thing will come back into demand, right? So the other con is that there are people who say that data centers for REITs are foregone conclusion because the big tech are building their own data centers, so they will not need to rent from these traditional REITs that buy data centers and rent them out anymore, right? So it depends on which side of the coin you look at lah. Alright. Right, Mapletree Logistics Trust. This one again is doing very well, and I think it's highly linked to online retail spending, right? So like any form of Shopee or Lazada or Alibaba or Taobao, I think they have some link to this REIT in terms of the fact that they need warehouse space for them to move their goods to and fro from, and Mapletree Logistics Trust is in that space, right? So they're really diversified. So I also don't know how to assess their risk factor in terms of FX, because I guess you could think of it as if one place doesn't do well, the other place could compensate for it. But in general, Singapore dollar tends to strengthen against most other currencies. So I tend to think of this as, in terms of FX risk, probably the highest. But Mapletree Logistics Trust, generally, historically, I believe is relatively well managed. I do not have the best background in this REIT, alright? So I have to admit that I'm not very proficient in the ideas behind this REIT, but it's only about 1 quarter in Singapore somehow. Right, and I'm looking at gross revenue for estimating its percentage in Singapore. Right, so yeah, with that, I think that's all for this presentation. Thanks for listening.